G'day and welcome to Season 2 of Harvestable by AgriDigital. Our 8-part mini-series will feature raw and unedited fireside chats with some of agriculture's most insightful minds, sharing their perspectives across the grain supply chain. In this episode, we are joined by Daniel Farrell, State Director of New South Wales and ACT for Markets at National Australia Bank. Now, before we get started, a quick note to say all information contained on any AgriDigital podcast is for education and entertainment purposes only. It is not intended as a substitute for professional financial, legal, or tax advice.
Hi, it's Henry Walsh from AgriDigital for the Harvestable podcast. Today, we've got Daniel Farrell from National Australia Bank, who's the State Director, New South Wales and ACT for Markets. Welcome, Dan.
Thanks, Henry. Great to be here.
Excellent. Before we get into today's topic, which is interest rates, inflation, and to a certain extent, credit markets, could you give us a bit of background about yourself?
Yeah, sure. Thanks, Henry. I've been with NAB for over 10 years, working across the financial markets businesses, right through from, our retail business all the way through to the institutional side. So I had a nice sort of beginning in that retail side right through to the insto space. I've also done a couple of stints across the bank, mainly in debt capital markets and also in relationship banking. I guess my team at the moment, I look after our regional and agri dealers. So we've got dealers based regionally in New South Wales who are supporting local businesses and farmers in those regions. They usually talk to customers about what's going on in the economy, particularly inflation is very topical at the moment in that space, but then also discussing how they can help manage their interest rate, foreign exchange and commodity risks.
Excellent. Yeah, you're right. Inflation definitely is the topic of the day. It doesn't matter what press you either read, watch or listen to. It seems to be all pervasive at the moment. So given that's one of the central topics of today, in terms of where we sit, what do you think is driving this change today? And in your perspective, do you think the speed of this change is unusual?
Yeah, it's a really interesting one in terms of, inflation and interest rate markets at the moment. I think the speed of change has certainly caught a few people off guard in an interest rate sense. Particularly, whether one way or the other, the central bank did sort of imply that nothing was happening until sort of mid-2024, as of, late 2021. And now we've obviously seen the whole landscape change. The market, though, has been quite consistent in terms of pricing in interest rate rises in 2022, so far earlier than, what central banks were indicated. And now we've seen this inflationary pressure hit not just obviously Australia, but around the world, and central banks are rallying to try to get it in check. The results of whether we see the success of that obviously is still to play out. You've got a central bank meeting tomorrow in Australia, and we'll see what they do there. But I would say that the what's driving this change is that that rapid change in the inflationary markets, which is causing central banks to move far quicker than expected. I've got to say that this isn't NAB research, but it's just more a general commentary about what we're seeing. But if you step back and look at where inflation was, over the last 5 years prior to this current spike, we've got an RBA target band of inflation of 2 to 3%, and for 5 years we were trading below that for quite some time, and there was even commentary about adopting a lower inflationary band target for some time. And that was despite the fact we had low interest rates, monetary policy was very, very accommodative. But then you had COVID hit, which forced rates one even lower. But then you had fiscal policy really come into force as well. And I think it's the combination of loose monetary policy and also supportive fiscal policy, which has really seen inflation move. That's obviously been pushed along further with COVID, with supply chain issues. Then there's subsequently been the war in the Ukraine and drought affecting the Northern Hemisphere and floods down here in Australia, which are not doing anything to alleviate these inflationary pressures. And there's just so many hurdles to businesses right now and they aren't trading at full capacity. So this is all having an impact. And I think that's probably been the key driver of inflation that we've seen over the last sort of 6 months or so.
Yeah, I think you make a good point. The confluence of events at the same time has exacerbated both the degree to which it's moved and the speed. In terms of inflation expectations, which is always a bit of a hard thing to pin down, do you think, at least within Australia, those have elevated, like at the consumer level? Do you think people are expecting prices to remain high, which is often a self-reinforcing effect?
Yeah. I mean, it's really hard to see a short-term outlook, I guess, in terms of inflation. I think longer term we do get back in with the band, and that's just because the central banks are so committed to getting there, and they will continue to lift rates until we see that 2 to 3% inflation band sort of entered into again. But I certainly think for 2023, inflation will be an ongoing issue and perhaps above the band during that time. But I guess it's also at the mercy of the global market aspect and how much the RBA can control. But also in terms of inflation here, while it's obviously been quite elevated, we're not still seeing the inflationary pressures that we're seeing around the world, certainly in the US and even the UK. I mean, you've got a central bank there saying that inflation could go through sort of 18 to 20 odd %, which we're not seeing, I guess, those dire forecasts in Australia, but certainly it's still going to remain elevated, I think, over the short term.
Excellent. And given that, do you, or whether it's, I know it's not a financial podcast or nor is it financial advice, but in terms of 2023, do you think, without sort of more, what is the view for 2023, but also, and that's a very hard question. I agree. I can but also, like, what signs would you be looking at to see that inflation is starting to moderate? Would it be unemployment rates? Would it be, obviously the CPI or PPI? What sort of things are you looking at?
Yeah, absolutely. I mean, I wish I had that crystal ball for sure, but I think it will be a persistent issue in 2023. I guess one of the really fortunate things that my team and I get to speak to is we speak to a lot of businesses, and particularly at NAB, and it's not, I guess, necessarily a plug for NAB, but we bank the regional and agri segment. So we speak to a lot of businesses. And so in terms of the trigger points that I'd be looking for inflation to be rolling over is essentially it's just got to get easier for them to do business. That would be the forward indicators for me. So I'd personally need to say I'd need to hear them that they're getting access to the staff that they need, that they're finding it easier to secure the materials that they need, that they're operating more efficiently, and that would be the lead indicator, I think, in terms of that I'd be looking for that turning point in inflation, or in fact inflation to come down, because the data that we're getting is quarterly in arrears aspect. So, I mean, that's sort of the lag indicator. I'd need, that would be the forward indicators that I'd be looking for, just in speaking with the number of businesses that we do.
Yeah, it's really interesting. In terms of events outside Australia, which even more harder to predict with, another ban in grain exports over the weekend. In terms, how much do you think that is driving events so far this year and into next year, whether it be wars or supply chain disruptions?
Yeah, I mean, that's the question, I guess, of how much the RBA can do. They're using, monetary policies as a bit of a blunt instrument. They've obviously been jawboning a little bit out there, being much more visible and talking about trying to get on top of inflation. I guess in terms of but there are a lot of those impacts outside of Australia, and the obvious ones are sort of the war in the Ukraine and the impact that that's having. I mean, Russia and the Ukraine account for 25% of the world's wheat supplies, 24% of the world's barley, 17% of the world's fertilizer. I mean, these industries are hugely disrupted at the moment and well outside of the RBA's control. There are other impacts as well. I mean, particularly on the Aussie dollar. And that's the other thing that they've got to be really conscious of. And the key player there is the US Fed. The US Fed is a lot more hawkish than our RBA at the moment about where the terminal cash rate could be. And there's talk of the Fed's fund rate getting to 5%. If that plays out, then and our central bank isn't as, I guess, hawkish is the term, I guess, for in their language, then the Aussie dollar is suffering as an account. We've seen that play out over the last month or so. But then the problem that does is by putting pressure, it means all the goods that we import are costing more, which is also going to be inflationary. So I guess a bit of a a few hurdles for the RBA there. Obviously, they're doing what they can on a domestic front, but there are all those international factors that you've sort of touched on that are also impacting inflation globally.
Excellent. Thanks, Dan. In terms of moving on to credit, I know that's generally not, it's a bit of a harder market to ascertain, but, credit spreads have widened over the last 6 months. And do you have any sort of view on what could impact these spreads going forward?
Yeah, sure. I mean, at a really simplistic level, credit spreads are essentially a measure of creditworthiness. So a measure of how likely a corporate is to repay their debts. Heaps of factors can contribute to those spreads, particularly when there's sort of times of huge uncertainty, like what we saw in COVID, where things blew out dramatically and then came back in. And there's also factors like the probability of recession and interest rate rises that can impact the spreads. I guess in terms of, you're right, we have seen credit spreads sort of tick out a little bit recently. I guess that's on the back of, what's driving that is probably the back of, the probability of recession rising and also interest rates. So in the market's eyes, the spreads have been ticking higher, I guess, over the last 6 or so months versus the 5-year average. If you take out the onset of COVID and those random events there, they generally have been ticking higher. Factors impacting them, I guess, for the next for 2023, I think the key will be uncertainty around the terminal cash rate. There's a lot of divergence in views there. The central bank has sort of identified anywhere between neutral for the cash rate could be 2.5% to 4%. The market is pricing in a cash rate sort of around about 4.3%, although obviously that changes a lot. And the market's also pricing B out at around 4.8% over the medium term. So I guess that will be the number one driver for 2023 about where that gets to. And then also obviously the recessionary factor. Predict the US is a higher chance at the moment, I guess, in terms of financial markets of going into recession and what that does in terms of contagion effects around the world for credit spreads, but incredibly hard market to predict.
Yeah, it certainly is a high period of high uncertainty across a lot of different aspects. In terms of, you just sort of touched on it towards the end there, in terms of, how do you think the Australian economy is going in digesting this higher cost of funding? And some related questions, how does this impact corporate profits, and which sectors do you think are most exposed over the next sort of 6 to 12 months? Yeah,
sure. In terms of there definitely has been an increase in funding costs for whether it be, the mum and dad farmer or the corporates. I guess there is a fair bit of a lag in it though. And I guess on the institutional level, companies will pick periodic times where they can issue and do that favourably. I guess more though for the where most businesses are banked, sort of in that business banking sort of mum and dad borrowers sort of style. There is a fair lag because they only really see the change in cost of funds when they actually renegotiate their loans. They may already be on a 3 or a 5-year term. And so the cost of funds typically for a business loan is locked in during that period. So they're not necessarily they're seeing the impact of higher interest rates if they haven't fixed their loan, certainly by the movement in BBSY, but they haven't necessarily seen the secondary piece, which is that cost of funds piece, which has certainly risen as interest rates have risen, and other things like the TFF was rolled off from the government, which was particularly cheap funding for banks introduced during COVID. So that only really takes effect when they renegotiate those, their loan terms, and so they still may not have experienced that. So there's a fair lag, I think, that we're seeing in that. So I think we'll have to wait, I guess, another couple of years to really see how that plays out in terms of for the cost of funds component. Yeah,
that's different type of lag, but similar in the housing market where a lot of people's mortgages will probably roll off in 2023 and see what impacts that has and impact across the broader economy.
Yeah, absolutely.
That's been really helpful, Dan, and really appreciate you informing us across all the different aspects of interest rates, inflation, and credit markets. Anything else you'd like to add in terms of the NAB view on sort of heading into 2023?
No, it's. I mean, I guess the driver in terms of in terms of interest rate markets is just something to look out for in 2023. There is a divergent in view between where the market thinks things will get to and some of the central bank commentary, and then also where the banks are predicting. So it's probably more divergent than I'd usually see over my time here. But I think in terms of uncertainty, there's obviously lots of if that's something that is concerning to any of the growers, all that sort of stuff, feel free to reach out to their sort of local NAB branch or NAB business bankers and agri bankers in the regions, and they'd be more than happy to put people in contact with someone that's willing to have a markets conversation with them for sure.
Excellent. All right, Dan. Thanks very much, and all the best.
No worries. Thanks, Henry. Have a good day.
Cheers. You too. Bye.
Thank you for listening to Harvestable by AgriDigital. We hope you enjoyed this fireside chat and see you next week for another episode.